I know when everything else is falling, gold and silver are going to be rising, and they're not just going to be rising, they're going to be rocket propelled.
I mean, the way to look at it actually is not gold is in a bull market, but all currencies in a bear market. Currencies are going down. I mean, the way you've got to look at it is you're not buying gold, you're getting the hell out of credit. Currencies are credit. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies.
When the system starts to crack, the truth isn't that gold is suddenly in a bull market. It's that every currency on Earth is in a bear market. What we're living through right now is the collapse of decades of unchecked credit expansion, where money was reduced to nothing more than promises stacked on top of debt. And once those promises lose trust, people rush back to assets that can't be printed, inflated away, or erased by default. That's why gold and silver aren't just going up, they're breaking out. They've become the ultimate escape from a fiat system that's losing credibility by the day. Analysts like Alasdair Macleod and Mike Maloney have tracked this cycle for years, showing how suppressed gold reserves, massive sovereign stockpiling, and silver's extreme undervaluation are pointing toward an inevitable reset in global monetary trust. Look at the signs. Eastern nations moving closer to gold-backed currencies, silver's booming industrial demand, and the breakdown of traditional price ratios. It all signals one thing: precious metals are about to be repriced dramatically higher against weakening paper money. Confidence in fiat is fading fast, and the world is shifting back to tangible value. This isn't just a market move, it's a global transformation. And before we dive into the clips, make sure you subscribe and hit that bell icon so you don't miss the next big update. Let's get started.
We all work on credit. We never, even under a gold standard, you wouldn't dream of paying your workmen or whatever in gold sovereigns. You would always pay with a bank transfer of some sort, a check or cash. In other words, a gold substitute, which is really what a Bank of England note is. So you would never really use gold. You always use credit. In any healthy economy, there will be a lot of credit around. But the problem becomes when there is too much credit, the debt, if you like, is unsustainable, and therefore the situation goes into collapse. If you have credit which is expanded to finance production, then basically you have an extremely healthy economy. Where it goes in to finance consumption, then you're driving up prices. And if you're not driving up prices, then what happens is that your gold reserves, the central bank's gold reserves, decline. And this was the situation that we had from about 1947, when the US Treasury's gold reserves were in the order of 22,000 tons. I mean, we're looking at something like 60% of above ground gold stocks at the time. By the time we got to 1971, it was down to just over 9,000 tons. The reason that there was a run on, if you like, on the US gold reserves is because prices were suppressed by the link between the dollar and gold. And people were taking out gold. They were exchanging those dollars back for gold because they realized that there was this tension, if you like, between the two. As long as you could exchange it for gold, then of course, what would you do? You would exchange your dollars for gold. And that's what nations were doing because, of course, you and I couldn't do it. We were banned from doing it. I think the interesting thing is that China and Russia have gold. They've got lots of gold. I understand that in two wealth funds, Russia has a further 10,000 tons of gold, which could deploy, if you like, on the central bank's balance sheet. So they would have about 12,000 tons, 13,000 tons. That's Russia. I reckon that by 2002, the People's Bank of China had accumulated gold in the big bear market from 1983 onwards. When it was 1983 was when legislation was passed appointing the People's Bank of China to handle the nation's gold reserves. And between then and 2002, Chinese individuals were not allowed to buy gold. So they had a clear run at it. And they tucked this away, not on their own balance sheets as reserves, but they spread it around. My information is that it's gone into things like, for example, the People's Army account and also the Youth Communist Wing's account and so on. So it was all spread around. I reckon they could have accumulated a good 20,000 tons. By 2002, which they then turned around and said, okay, we're going to set up the Shanghai Gold Exchange and individuals can now own gold. And they have been accumulating gold ever since. And if you look at the withdrawals from the Shanghai Gold Exchange, they total around about 27,000 tons since 2002. So China can go onto a gold standard, I think, quite quickly. The reason she hasn't is she knows that if she goes onto a gold standard, she will destabilize the global dollar-based fiat currency system. And that's not her style. She rather watches America make all the mistakes. And I think that there will come a point when China and Russia will put their currencies onto gold standards to protect those currencies from the collapse in our currencies. So it's probably not all that far away now. Well, silver is fascinating because, I did some analysis. For those who want to subscribe to my Substack, I did a bit of analysis on the relationship between gold and base metals and sort of indexing them back to about 1900. You look at the value of a basket of base metals and they are about 25% of that 1900 value measured in gold. Now, this is important. Okay, gold is maybe a bit ahead of the curve in these circumstances. One can understand that. But the basis of the suppression of base metal values has been the inflation of credit and the falling purchasing power of credit values not being reflected, if you like, in the value for these metals, for a basket of metals. So even measured in gold, the potential rise in base metals could be as much as 300 or 400%. And that is without considering gold rising. Now, so even if you regard silver as a base metal, without considering any of its monetary qualities, any of its monetary history, you can see it's wildly undervalued, particularly because of its really quite extraordinary properties. It's the photovoltaic cell industry is just booming, defense, etc. Also, the sort of antiseptic qualities, the way it kills bug germs and all the rest of it. I mean, there's so many uses of it. It's the best electrical conductor, the whole thing. This is, I would say, it should be more valuable than even lithium. So on that basis, silver is very, very cheap. And we have the situation where people are beginning to realize that gold, they'll sort of think, well, gold is going up again. And when gold is going up again, how do we play this? I mean, can we really afford to buy gold, say, at $3,700 or whatever the day-to-day price is? It's probably easier to get into silver because silver's got left behind. So I think you'll see that the gold-silver ratio fall quite rapidly, well below 80, well below 70, well below 60. I see it falling below 50. I don't want to put a timescale on it, but it does mean that you could be buying, when you switch back into gold, in effect, you're buying twice as much gold at the future price by leveraging it up through silver.
The Buffett Indicator has long been one of the clearest warning signs of market excess. And right now, it's screaming red alert. U.S. stocks are valued at more than twice the size of the entire economy. To put that in perspective, today's valuations make the dot-com bubble look modest. When analysts strip away distortions from crashes, currency failures, and hyperinflations, the fair value for markets sits around 23% of GDP. Yet for decades, we've stayed locked in bubble territory, never returning to equilibrium. That's not stability, it's a warning. Layer on top of this the extreme price-to-earnings ratios, Tobin's Q near record highs, and the fact that just a handful of mega-tech companies now carry most of the market's weight. These aren't signs of strength. They're symptoms of a system kept alive by endless credit expansion and speculative excess. And history is crystal clear. Every period of hypervaluation ends the same way, in painful corrections that wipe out illusions and force balance back into the system. Now, let's get back to the interview.
This is the Buffett Indicator. The Buffett Indicator, it's showing that, this is undervalued down here, where the value of the publicly listed stocks in the United States is less than 50%. And the actual average, if you ignore the bubble century, the average for the previous 100 years was between 50 and 60, not up here at 86. This is measuring mostly where everybody has lost their minds and they place these insane valuations on stocks. And this truly is mind-boggling. The Buffett Indicator, so publicly listed stocks in the United States are worth more than 2 times the U.S. economy. Now, this is from the book, The Great Gold and Silver Rush of the 21st Century, and you've got stock market capitalization to GDP of 17 countries, and this is an interquartile chart. An interquartile chart, you take 100% of these 17 countries. You eliminate the top 25% and the bottom 25%. You just take the middle 50%, so that you're eliminating the outliers that can skew data. So this gray shadow here is the middle 50%. What this does when you eliminate the top 25 and the bottom 25 is you eliminate currency failures, stock market crashes, you eliminate hyperinflations, events such as that can skew the data. And so this is very, very conservative data. And what you see here is globally, it was at about 23% of the, this would be about 25% there. About 23% was fair value. And then in the late 90s, we went into the bubble century, and we've been there ever since. And this stops back in, I think, 2015 or 2016, something like that, the data. And this is by a couple of European economists, Dmitry Kuvshinov and Kaspar Zimmerman. And it's obscure data, and we were able to find it and put it in the book. So the first time it got widely released, it was when we released The Great Gold and Silver Rush of the 21st Century. Hours worked to buy the S&P 500. So that other data went back to like here, and then another data set went back to 1947, right here. But when you add this extra 100 years of data, 1860 to 90, this 100 years of data that wasn't in those other data sets where they had an average. Well, the average here, hours to work to buy the S&P 500, is 23. And when this chart ended, this was 2022, it was 123 instead of 23. It's insane. This is the bubble century, and things will come back down to earth. But I think this time, they're not, when the stock markets crashed in 2000, we didn't even visit fair value on this. When they crashed in 2008, we almost visited bubble territory, but we didn't visit fair value. Going back to the Buffett Indicator for 17 advanced economies, same thing. We didn't come down to fair value. Berkshire Hathaway has dramatically trailed the S&P 500 since May, and this happened in the dot-com bubble just before everything popped, global financial crisis, the COVID pandemic, and here it is again. NASDAQ market cap reaches record 145% of the U.S. currency supply in Q2 of 2025. The NASDAQ is valued higher than the currency supply of the United States. This is M2, so this includes all of the bank credit. About 92% of the currency supply of the United States is created by the banks, not the Federal Reserve. So it's just bank credit. Relative overvaluation indicators across historical bubbles. So the 1929 bubble, remember these dates, 1929, 1966, 1999, and 2025. Now, 1966, the reason this doesn't show much overvaluation, I'll show you that in another video. But here we have the Shiller cyclically adjusted PE ratios relative to the mean, trailing PE ratios relative to the mean, the Buffett Indicator, so the value of the publicly listed stocks compared to the size of the economy relative to the mean, Tobin's Q. Tobin's Q is a measurement of it's how many times the current valuation of the company is over the replacement cost of that company. If you were going to scrap the whole thing and start over again, build the company from scratch, build it up to today's sales, what would it take? So that's Tobin's Q. And so you can see where we are today. Tobin's Q is equal to 1999. The Buffett Indicator is way over 1999. Trailing PE is a little bit lower, Case Shiller, we're going to visit this later, but not quite as high as 1999. But we are in super hyper bubble territory where we get devastating crashes afterwards. This is the Magnificent Seven, median enterprise value to free cash flow. And look at what's happened since 2009. We are at just these insane valuations that cannot last. The S&P 100 PE ratios exposures. So 27.2% of the S&P 100 is in companies with PE ratios. So it's the value is in PE ratios above 50. So 27.2% of the value of the S&P 100. And then 2/3 of the S&P 100 has a PE above 30. Now, if you go to the previous century, this was considered fair value right here. This was undervalued. There's one company that's considered undervalued. This was considered overvalued. This was considered extreme bubble territory. Any of this would have been, was like off the charts. That hadn't happened before. This was hyper bubble territory. So moving on. A buddy of mine just flagged me that NVIDIA market cap is 3.7% of global GDP, the entire world. Now, I got to meet, Chris Martenson and I went and met. Chris Martenson had made the appointment and he invited me along. And he came to California and we drove down, and this was, I think, in 2013, because I had just gotten my 2012 Tesla Model S, the 599th Model S produced. We went down to visit a man named Richard Russell. Richard Russell started the very first financial newsletter, I believe, 1956, the year I was born, and it was called Dow Theory Letters. And the theory is that when the Dow transports that measure just the companies that are moving all of the goods in the United States, the railways and the trucking lines and so on, the shipping companies, when they lag the value of the stock market, it's a warning signal that the stock market is getting way overvalued and there's a crash coming in the future. And it was highly reliable. And his newsletter was called Dow Theory Letters, and that is Dow Theory, that when the transport, so you can see this tremendous correlation, and then a divergence starts. And this is just, there's a couple of years here before the stock market peaked and crashed in 2000. Well, look at what has happened here. The closest point here was July of 2023, and they have been diverging ever since. Big divergence coming since the third quarter of 2023. And so this is a warning signal to pay attention to. And I know when everything else is falling, gold and silver are going to be rising, and they're not just going to be rising, they're going to be rocket propelled.
What we're living through today isn't just another cycle of overvaluation. It's the final chapter of decades of reckless credit expansion and financial engineering. The bubbles in the equity markets, the distortions in the bond markets, and the false sense of calm in currencies are all part of the same fragile structure. And when credit stops expanding, or when confidence finally cracks, the correction is never gentle. It cascades across markets, undermines currencies, and forces a brutal repricing of everything. History shows us that extreme imbalances always resolve themselves, often far more violently than anyone expects. That's why tangible assets matter. Precious metals can't be conjured out of thin air like paper claims. They are real, they are scarce, and they are insurance against the inevitable consequences of systemic leverage and policy mistakes. Whether it's gold holding its ground as currencies collapse, or silver finally closing the gap, after centuries of undervaluation, hard assets always reclaim their role when trust and credit evaporates. That's why staying prepared and positioned is no longer optional, it's essential. Now, I want to hear from you. Do you believe gold and silver will lead the way out of this fragile system? Or will the next reset introduce something entirely new? Maybe a digital or commodity-backed currency? Share your thoughts in the comments below. Your perspective could spark the discussion that others are looking for. And if you found value in this analysis, don't forget to hit like, subscribe, and ring the bell for more critical updates. Your support helps us bring these conversations to a wider audience.